So I'm really pleased to have with us, folks, Ryan Donovan, who's the Chief Advocacy Officer for CUNA, and I know you're all familiar with the name and have seen his picture around a lot. Ryan has been, I found out that Ryan has been with CUNA for 13 years now, and what a coincidence. You're celebrating your 13th year with CUNA, Ryan, and along with that 13th year comes this pandemic at the same
Yeah.
time. So,
Who knew? I thought I said the last financial crisis was going to be my last financial crisis.
yeah, there you go.
Who knew?
Ryan's been Chief Advocacy Officer at CUNA since 2015, worked for the California Credit Union League in government relations for a number of years, and way back in ancient history at some point, also worked on the Hill for Brad Sherman and Dick Gephardt. So he's got a really well-rounded experience in all of his different positions he's filled in his years and whatnot. And we're just really fortunate to have him. He covers for CUNA, if you didn't know already, everything to do with federal legislative issues, federal regulatory issues, and then CUNA's monitoring and coordination of state level issues too between credit union leagues and the organizations and whatnot. So we're really fortunate to have Ryan at the helm. I can tell you that I've seen a lot of people come and go from CUNA's Washington office and the advocacy function and whatnot. But during Ryan's tenure here, the advocacy efforts by CUNA under Ryan's leadership have really been ramped up and much more effective than they were in years past. So thank you for that, Ryan, on behalf of Vermont Credit Unions. And thank you for joining us today.
You bet. Thanks for having me. Joe, if it's okay, I do have a few slides that I just want to go through. But before I do, I spoke with the Mississippi Credit Unions last Friday, and we got to that point at the end of my talk where it was time for questions, and there was kind of silence. And so then I said, well, I have a question then. And so the question that I have, just for folks to think about as I talk a little bit about where we stand on some of our priorities, how COVID's really impacted our advocacy efforts, and I'm also going to talk a little bit about the election, not in terms of necessarily what's going on right now in the campaigns, but how we view potential outcomes. The question that I would ask folks to think about, and maybe we could have a discussion about, is are we focused on the right things for credit unions? How do you see 2021 shaping up for you? And are there things that you don't hear me talk about that you think we should be focused on? So if you keep those in the back of your mind and maybe use that as a springboard for conversation, then I'll talk a little bit about each of those things that I mentioned in terms of just sort of level setting our principles and our agenda, talking about COVID impact, the current issues and scenarios and outlook. Joe Bergeron has probably seen this slide more times than he cares to admit because I start every presentation with it. But this is our advocacy goal. It's in CUNA's strategic plan, so it comes directly from our board of directors, excuse me. And it's to revolutionize the operating environment for credit unions through expanding powers and removing barriers to serving consumers and businesses. And I start with this because I think it's very easy for us, and when we think about advocacy, to jump to a point where our goal is to get a rose garden ceremony and a bill signing with the President of the United States. And that's nice when it happens, but it's just not our goal. It's not what we set out to do. We're really trying to put the credit union members in the center of our advocacy. We're doing this to make life easier for you so you can do more for them. And we go through it with an advocacy strategy we call 360-degree advocacy. It's fierce, bold advocacy. Joe mentioned that I've been with CUNA now for 13 years and before that with the League. And I could say with some humility and some authority that fierce and bold were not two words that most people would use to describe our advocacy efforts until maybe 5 or 6 years ago. Even when I was a part of leading that effort, there was still a tendency too often to sort of sit back, keep our heads down, hope that nothing bad would happen. But when you do that, you find that you're not at the table, you're on the menu. We want to be at the table like we are right now, helping to set the menu, to set the agenda. And we do that by addressing issues from all angles. So one of the things that Jim Nat'l and I have really brought to advocacy as we've worked together over the last several years is this idea that there are no legislative issues, there are no regulatory issues, there are no issues that only pop up at the state level or in the courts. For us, it's all credit union issues. And so we have to look at it as a credit union issue, which means that sometimes it might present itself in the legislature, but can you use the regulator to help influence the legislature? Or when the regulator is taking a proposal forward, is there opportunity to leverage the legislature to get the outcome that you want? So we look at issues from all angles, and we try to saturate policymakers with our message so that they're hearing the same thing in Washington as they are back in Vermont, and really trying to leverage the strength of the CUNA League credit union system to deliver a consistent message, whether they're hearing it in their office in Washington, their district office in Vermont, the grocery store, on the radio, in the newspaper, on the web, wherever. We want them to hear our message. And we need to do, in order to do that, we have to be united. And I'll tell you, we do a lot of, we are subject of a lot of research in Washington because of the size of our industry and the impact we have in advocacy. And in one recent study conducted by Ballast Research, a division of the National Journal Company, the CUNA League system was rated #1 of all associations in terms of their ability to deliver a unified voice for the entities that they represent. This was the third year in the last 5 years where we've been #1 overall. And for the last 5 years, we've been #1 in financial services. And this is really critical because policymakers will take you more seriously. They will put more stock in your message when they understand that you've got everybody in that industry behind you. And so we're real proud of that. And I think it's a real testament to the work that leagues, CUNA, and credit unions do together in terms of advocacy. Of course, what really helps us out, beyond having a well-focused goal and a good strategy, is having an agenda that's reflective of the needs of credit unions to take to policymakers. And this year, our agenda has 4 pillars: reduce regulatory burden, expand and protect powers and opportunities, enhance information security, and of course, preserve the credit union's tax status. And we build that on a foundation of financial wellness. So what that means is that as we are trying to reduce regulatory burden or expand powers, as we go after those 4 pillars, we really try to keep the credit union member at the center of the advocacy, so that when we're talking about the impact of policy, we're not just talking about the cost to the credit union, but the impact to the credit union member. And I'll tell you, we had big plans for this agenda this year. If you were at the CUNA GAC, you heard us talk a lot about the need for a national data privacy and data security law, and how we thought there was a pretty good chance that we were going to get that this year. But while we were at the GAC, there was this virus that was developing, and the day after we got back into the office, we stood up an incident response team to really begin to think about how a global pandemic might impact credit unions. And in my case, and my team's case, what will that mean from a public policy perspective? And this is, I refer to it as my periodic table of COVID-19 issues. These are the different issues that we have begun and we've been working on since the beginning of this pandemic. And the colors mean something, and I'll be happy to share the deck with you so you've got the code. But you know, the first group of issues really has to do with things that have been resolved. So in the early days of the pandemic, we spent a lot of time, you know, encouraging policymakers to include credit unions in the solutions. We had some, frankly, irresponsible journalism out of the northwest part of the country and in New York State that, you know, suggested credit unions might have to, banks might have to close. This really put some runs on cash in institutions, and we worked closely, not just with the communications folks, but also with the Department of Homeland Security, and leagues worked closely with their governor's offices to make sure that credit unions were designated as essential services so that they could remain open. We got NCUA and the CFPB out of credit unions for their examinations, and we got the regulators to suspend new rulemakings. We started to hear comments from credit unions, particularly federal credit unions, in March and April about their upcoming board meetings and membership meetings. Could those be held virtually? And NCUA, at our encouragement, made some changes and gave some guidance for that. Then there was the CARES Act, which was actually the third round of recovery legislation. That included expanded authorities for the Central Liquidity Facility, expanded accommodations for troubled debt restructuring. It included NCUA, it gave NCUA some tools on increasing deposit insurance, share insurance levels. And of course, it also included the Paycheck Protection Program, which several credit unions have taken advantage of and helped their small business members. But you can see here all the issues in green were things that just in the first, I'd say, 6 to 10 weeks of the pandemic, we were focused on and got a positive result. We didn't bat 1,000. In the CARES Act, there were some provisions that if we were writing the bill, we wouldn't have included. Provisions related to adverse credit reporting and mortgage deferrals. But we were also able to keep some bad things from happening. So there were some proposals in the House of Representatives that there would be an overdraft moratorium where banks and credit unions would have to cash benefit checks for free. There'd be a moratorium on confessions of judgment. And we were able to get those set aside as Congress considered recovery legislation. But we've got a whole host of issues that remain. We're spending a lot of time right now working on Paycheck Protection Program forgiveness. There's a whole set of policy options that I'll walk through here in a moment that we're working on in the recovery bill, and then continuing a list of regulatory issues that we continue to work on. Some are, kind of in the minutia, like this national coin shortage that's taking place. Others are, things that we are constantly working on, but in this COVID environment take on added importance, like the NCUSIF's normal operating level and the equity ratio and things of that nature. So a whole host of issues that have popped up. And I'll tell you that in May of this year, Joe's heard me tell this story a couple times, I think. I was fully prepared to go to our advocacy committee, and John may recall this as well. I was fully prepared to go to our advocacy committee and suggest that we set aside our normal advocacy agenda and focus only on these issues. And my team actually pulled me back from that and stopped me from doing that. And they said, Ryan, you don't need to do that because we've actually made a lot of progress on normal advocacy issues. They said, well, listen, we've been trying to get the Reg D transfer limit eliminated for 8 years. And it may have taken a global pandemic to do it, but the Fed did it. And so we should take credit for that. We got the NCUA to increase appraisal thresholds for residential and commercial mortgages. The CFPB increased the remittance threshold. Low income designation. We've been talking to NCUA for years about how can we expand the definition of low income credit unions so more credit unions can qualify. And using, we thought a good idea was to use APO and FPO addresses to identify service members as low income. NCUA under Chairman Hood's leadership said, we don't even need the addresses. Let's just include everyone who is in the service, armed services, as a low-income member for that purpose. We won a huge court battle against the ABA over field of membership. NCUA was the named party in the case, but CUNA Mutual Group, we joined together to file an amicus brief in support of NCUA's position at every level. The Supreme Court a few weeks ago decided not to hear that case. A huge victory. They could have heard the case. They might have ruled against NCUA, which would have put us right back where we were in 1998. But instead of that, because of the work that we've done over the last couple of years, we're in a position now where NCUA is actually looking at the field of membership regulation for federal credit unions and saying, what more can we do? How could we go even further? Which is a fantastic position to be in. And we've been working very closely with our league partners at the state level, where even before COVID, state budgets were under considerable pressure, trying to work with them to find ways to go on advocacy offense in terms of preserving the tax status, so that we're talking about credit unions' impact on their members and how they advance communities long before there's an actual tax threat. Well, right now we still have a lot ahead of us between now and the election, and certainly looking into 2021. So as Congress continues to debate recovery legislation, we have 10 or 11 issues that we're trying to advance in this process. We'd like to make the paycheck protection process, the forgiveness process, easier for small businesses. So if businesses have loans under $150,000, we're encouraging a streamlined process there. We need to get some of the provisions from the CARES Act extended. The CLF provision, the troubled debt restructuring provision, those expire at the end of the year, and we're asking Congress to extend them one more year. We'd like to get credit unions a little bit more flexibility for prompt corrective action. And so we've proposed legislation where if you went into the crisis as of March 1st, if you were adequately capitalized or above, but because of COVID, your capital level has slipped down to undercapitalized, NCUA could, on a case-by-case basis, forbear prompt corrective action. That language is being considered right now by the Senate Banking Committee Chairman Crapo. We've had conversations with NCUA and also with the House Financial Services Committee, but we drafted this language based off a proposal that was put forward after Hurricane Katrina. It's specific to this crisis, and it's temporary flexibility. We're hopeful to get it in. But just as you can see here, a whole host of other issues. I'll mention one other, since I know there are a couple of federal credit unions on the call. In the CARES Act and also in the Families First Act, which was the second coronavirus legislation, there were some payroll tax credits that were given for paid family leave and a couple of other workplace issues. The language excluded federal instrumentalities from claiming those tax credits. Federal credit unions are federal instrumentalities. We've been trying to get the Treasury Department to issue a ruling that those provisions don't cover federal credit unions. And the argument essentially that we're making to the Treasury Department is that if you look at the way that the section title is listed, it's intended to prevent government employers from claiming this tax credit. Well, there's no area of law where federal credit unions are considered government employers, and federal credit union employees are not federal government employees. So clearly the intent wasn't there. We haven't been able to get Treasury to do that. The good news is that both the House Ways and Means Committee and the Senate Finance Committee both understand that this is an error. It was not intended. The trouble is everybody's pointing at somebody else to fix it. We had a good call last week with the Senate Finance Committee Chairman, Chuck Grassley. He gets it very clearly. We're really hopeful to get a positive resolution on that. And some folks will say, well, why are you spending so much effort on this tax credit issue when credit unions are tax exempt? Well, credit unions, as everybody knows here, are tax exempt from corporate income tax, but we still pay payroll tax, and this is a payroll tax credit, so we need to make sure that we provide the same treatment that every other employer in the country is subject to. All right, well, let me just go back here just to touch on a couple of other things before I move on. I'm not going to go through this whole list of issues, but a couple that I'll pull out. The first is postal issues. You're hearing a lot on TV right now about the changes that the Postal Service are making, and it's all focused on ballots and everything. One thing that I would be interested in knowing from folks is whether or not you have seen any delay or degradation of service in terms of the mail that you may be sending your members, whether it's bills, bill payments, things of that nature. We have been, postal reform has never been our front and center issue, but we've worked closely with the bankers associations over the last several years as Congress has considered postal reform to make sure that the Postal Service was able to meet the needs of financial services entities. We know that the pharmaceutical industry is very concerned about the changes that are taking place, and so we're interested in getting some feedback on that. The other thing that I would point out just in terms of this list before I get to the elections is that there has been a nominee for the NCUA board, Kyle Hopman of Maine, has been nominated. He's had his confirmation hearing and he's been voted out of the banking committee. We're hopeful that he'll get confirmed by the Senate when they return in September. There's a chance that he could be on the NCUA board at their next meeting in September. And then, just in terms of the elections, with the Democratic convention being this week and the Republican convention being next week and everything else that's going on, frankly, it's on everybody's mind. Here are some things, here's the way that we're looking at it. And I'll start with just some assumptions and dynamics that we're considering that are really independent of the outcome. As we look into 2021, as we look into the rest of the year, no matter what happens on November 3rd, this is kind of the assumptions we're making. The first is COVID's with us now. It's going to be with us well into next year. And Congress is going to have to deal with that. And the administration, whether it's the Trump administration now or the Biden administration next year, are going to have to deal with that. But coming out of this, we don't expect that there's going to be major financial reform. So there is certainly going to be an economic crisis. It's going to have a tail to it that's probably going to be longer than public health crisis. But unlike 2008, we don't expect major financial reform coming out of this crisis. We don't see a vaccine or a therapeutic remedy being made available in the near future. And so we are working under the assumption that to forestall the most significant consequences of an economic crisis, that the Federal Reserve and Congress are going to continue to pump money into the economy. We assume that there's going to be an election in November. It's crazy to write that, but it really does inform a number of other things. We've learned not to take anything for granted these days, but that the results of the election may not be known immediately. It could be several weeks before we know the precise control of Congress. We may know the majority control, but we won't know the ratios. And it's also conceivable that the outcome of the presidential election may not be known for a couple of weeks afterwards. Regardless, we believe that whoever wins the presidency is likely only to serve for 4 years. Therefore, posturing will begin for the 2024 presidential election very soon after. And that's going to play into the dynamics of a new Biden administration potentially, because it'll mean that he'll have a very short honeymoon. He may be elected with Republican crossover voters at his back, but once he's in there, I think that we're going to see, I hesitate to say politics as usual, but you are going to see more issue-focused disagreements between the parties, even with a President Biden's Republican supporters having helped him get elected. Congress will try to do COVID relief and regular order. We're already starting to see that, but it's going to become that much more important in 2021. And the real consequence here is that, and you'll see this as I talk through a few of the scenarios we've been looking at, local, state, and federal budgets are going to be under extreme pressure. And let me put it in perspective at the federal level. The Troubled Asset Recovery Program, the TARP program in the last crisis costs, I think, $780 billion. When it's all said and done, the federal government alone could spend close to $15 trillion on COVID and COVID recovery legislation. It's larger than really larger than I think anybody could have contemplated going into something like this. And at some point, the bill for that's going to come due. And that's just at the federal level, where the federal government can, more or less print money. State and local budgets, are much more constricted. And so I anticipate a dynamic where policymakers begin to look at the whole concept of taxation differently than they have going into it. So we've operated under this assumption for the last 50 to 80 years that nonprofits don't pay tax on the money that they bring in. We hold that to be true because it has been for so long. But there's nothing constitutional about that. There's nothing, that's the way Congress has established it, and they could rethink it. That's the type of thing that I think causes us some concern when we think of how our government entities are going to end up paying the bill for the spending that's taking place right now. In terms of credit unions, and I'd welcome anybody to either pile on here or argue with me. But what Mike Schenk and our economists say, and I think other observers, is that credit unions particularly into 2021 are going to be under increased financial pressure. It could accelerate consolidation rates. We're already seeing consumer choices and demand change. Just by way of example, I always share that since March, I haven't used a plastic credit card or debit card. I've only used contactless payment through my phone. That is a type of change perhaps that we might have expected over a 5 or 7 year period, but it's happening much more quickly. And I'm sure you have examples of other changes in consumer behavior. And we're going to have to take those into consideration as we look at policy and policy changes for credit unions to make sure that credit unions can remain relevant in a quickly changing environment. And then in Washington, as I was saying to Joe earlier, the Capitol complex is closed. It's inaccessible to the public for all intents and purposes. And if you talk to folks on the Hill, they will say, well, we're hopeful that we can open it in January. They'd like to have a swearing in, where public could participate, also an inauguration. I think it's really unlikely. I think when you start thinking about what it would require to do something like that, it becomes non-feasible. So well into next year, maybe June, maybe even later next fall, we expect the Capitol complex to be inaccessible, and Congress will continue to use virtual hearings and proxy voting to conduct their business. That makes large gatherings pretty complicated. And so we will have some information in the coming weeks about what that means for the CUNA GAC next year. But that type of event is really hard to do in a situation like we're facing. So with all that as foundation, there are really five possible scenarios. 4 of them appear plausible. If you want to talk to me about the scenario where President Trump wins re-election, the Republicans hold the Senate, and the Republicans win back the House, I'd be happy to do so, but at another time. We just don't think that that's a likely scenario right now. But these 4 scenarios before us right now, we do think are plausible and the most probable. And you can sort of see them out here, from the status quo on the left to a unified democratic government on the right. And I'll walk through very quickly what each of these 4 would mean for us. In the first scenario, where we pretty much have the status quo, I think you can expect the administration is going to continue to make use of executive action to boost the economy and try to reduce regulatory burden on entities like credit unions. You'll have Kathy Kraninger continue as CFPB director for a few more years under this environment, and certainly the trajectory that she has led the agency has been positive in terms of reduction of regulatory burden. Chairman Hood will stay at NCUA and continue to do the work that he's been doing. In general, we would expect some responsive federal agencies, and maybe there would be some bipartisan legislation, but I've been saying that for 4 years, and it really hasn't come to fruition, and I'm not sure why it would. in a second term under those conditions. The second scenario, similar to the first, the president wins re-election, Democrats hold the House, but they take the Senate. And in this scenario, all of the oversight and investigation that you've seen in the House of Representatives the last 2 years, you can multiply it and apply it to the Senate. So the Senate will conduct the same types of investigations. In this scenario, the president will have a much more challenging time getting his nominees through, particularly his judges. And Congress will try to use its tools to slow down regulatory change. And one of the tools they have at their disposal is the Congressional Review Act. I put here that there's opportunity for bipartisan deals under this scenario, in large part because if the administration wants to get anything done through Congress, they'll have to work bipartisanly. Again, we haven't seen a lot of evidence of that over the last 4 years, but if it's going to get done, that's how it's got to get done under this scenario. In scenario 4, this is a scenario where Vice President Biden is elected president. The Democrats hold the House and Republicans hold the Senate. So everything stays the same except for the White House. I expect the Biden administration to more or less pick up right where the Obama administration left off. And they will also have to figure out what to do with the last 4 years of regulatory changes. So there's been, we've just had a significant amount of regulatory rollback over the last 4 years. And I think that they'll take a very close look at what needs, from their perspective, to be reinstated. The Senate's not going to do a President Biden any favors in terms of his confirmations and his nominations, aside from perhaps his cabinet level. Usually a president gets an easy road on most of his first cabinet picks. In this scenario, you could see a number of members of the Senate, Democrats in the Senate, move to the administration. The theory being it'll be more enjoyable and certainly a greater opportunity to have an impact if you are a member of the president's administration than a minority member of the United States Senate. So I've picked, 3 that I think could go into the administration. It's feasible that there could be a role for Senator Sanders in a Biden administration, or Congressman Welch. Probably more so Congressman Welch than Senator Sanders, just because I think Senator Sanders has a platform that he may not want to give up by going into the administration. But in any case, I think you can see the point that if you're in a position like a U.S. Senate seat as a Democrat in a Biden administration, it could be attractive to go and work in the administration. Expect a new CFPB director under this scenario. The Supreme Court ruled a few weeks ago that the president has the authority to fire the CFPB director at will. And I think that if she doesn't resign on Inauguration Day, that the administration will move to fire her. The last scenario really envisions a unified Democratic government. Again, a Biden administration picks up where the Obama administration left off, and they see a mandate to advance their agenda. This will mean they'll take a look at rules that have changed, sort of the 11th hour rulemaking that the Trump administration will try to affect, and they'll try to roll that back. Gives us some opportunities, maybe, if we can align what we'd like to see in terms of charter enhancements with the priorities of a unified democratic government. There's a chance that we could get some expansion of field of membership, member business lending, those types of things. At least the conversation changes a little bit. I wouldn't anticipate to see as many departures from the Senate in this scenario, because it's more fun to be in the majority in the Senate than it is in the minority. And as I mentioned, with Senator Sanders having a platform, well, each of these Democratic senators has a platform as well, and in the majority, they're able to carry that forward. In terms of the regulations that we're going to be looking at very closely, or expect the Biden administration to take a close look at, you can see them here, and they really run the gambit of of things that we've worked to improve over the last 4 years, whether it's remittances, HMDA, payday, keeping us out of the debt collection rule. All of that I think will be under review. So we will be going from a posture of trying to get regulatory relief to one where we're defending against renewed regulatory burden next year. So these are my observations just based on what I've shared with you today. I think we're in a really good position from an advocacy perspective, even though there are a lot of things that are out of our control. We don't control the virus, we don't control the recovery, but what we do control, we have under control. We have this tax fight, or at least this tax threat on the horizon. There's light at the end of the tunnel. I just hope it's not coming right at us real quickly. In this case, it's driven not by the bankers. You notice I didn't talk about how the bankers want to see us taxed. They're certainly not going to help, but this is driven by the condition of the state and federal budgets. We have opportunities on charter enhancements. I think if we can align our interests with the policy goals of the folks in power, and we're going to be playing a lot of defense in a Biden administration against increased regulatory burden. So that's sort of my message of what I've got to share. I'd invite you, let's have a conversation or discussion. Feel free to argue with me or ask me questions. And also here's my contact information, and I will stop sharing the slides so that we can see each other. And that's my story. Joe, how'd I do?
Great. I sure don't want to be arguing with you, but you do remind me at the end of all of this of the couple times in my college days, so very, very long ago, where I actually thought that going through the real Cliff Notes version of a college text or book or whatnot would be helpful, where they just throw all the most important things to you like a fire hose, and I feel like that's what you just did.
That's one of the things. Someday I'm going to learn how to not deliver it like a fire hose, but it's there's just a lot going on.
I mean, sure is.
You recall your colleague Paul Mercer a few weeks ago gave me a hard time for that periodic table chart. He said, Ryan, we need to focus in on, we need to have a simpler message. And I agree. I'd love to have a simpler message. My issue is credit unions are complicated, and there are a bunch of issues that are coming at us right now. And what I tell my team is we need to always be trying to bat 1,000, right? We're not going to bat 1,000. You saw a couple of things on there that if we were writing the stuff, we wouldn't put in there. But we're going to do our best to try to bat 1,000. And if that means we got to go 65 for 65, we'll go 65 for 65.
Right.
So Ryan, this is John. I'm going to jump in if I can and perhaps answer the question you asked at the beginning, because I don't know whether it was on the periodic table, but the topic of GSE reform and specifically, what happened last week by the GSEs for the refinance fee. So 2 questions along those lines. First, whether you or Mike Schenk is really didn't show up, I don't think, in the June data, but there's some sense that the level of mortgage volume will soften the economic hit to credit unions this year, probably not next year. But what your read is on that possibility, just from a sales volume standpoint. And secondly, what's your GSE prediction in the, maybe the not all 4 scenarios, but maybe a couple of the scenarios that you ran through?
Okay, so on the first level, on the first question, I think what we're seeing from credit unions right now, some credit unions are reporting, record levels of refinancing, and in some markets, for example, the areas around Los Angeles, for example, I'm told are seeing, a lot of purchase and sales in those areas as folks kind of are saying, listen, I'm going to be working remotely, so I don't need to live in downtown LA. I can live in Palm Springs, right? So you're seeing that type of mobility, I think, drive sales. And frankly, I don't know anything about the Vermont market, but my guess is the proximity of certain areas of Vermont to New York City and Connecticut, and if you could move to Vermont and have a lower cost of living and still do your job that's with a company out of New York or anywhere in Connecticut, that might not be a bad thing to do. So I sort of see that type of thing driving it. In terms of the prospects for GSE reform, I'm going to punt a little bit on this, except to say that I've always said that Congress won't do major reform of the housing finance system in the absence of a crisis that debilitates the system, right? And if it is true that the economic crisis has a longer tail than the public health crisis, you could see the ingredients of the system fracturing into next year, which could increase the likelihood. Calabria, I think, wants to see the GSEs recapitalized quickly. I think that's one of the reasons why he allowed the fee to go into effect, recognizing that there's a lot of refinance right now and try to recoup some of that. But I think a Biden administration is going to take a 180-degree opposite approach to it. There is a comment out, or a proposal out for comment on the capital structure of the GSEs right now. We're going to submit comments on that before the end of the month. I haven't talked, and we just brought on a new attorney, Damon Smith, who's working on those issues. And Damon's got a lot of experience in this. He was the former general counsel or acting general counsel at Department of Housing and Urban Development. So I'm going to follow his lead on this. And John, I'll as we approach that, I think that's going to give us some sense of what next year could look like. But I think if the system really breaks down, that's what's going to force Congress's hand.
Thanks.
You bet.
Other questions, folks?
Hey, this is Jean from Vermont Federal Credit Union.
Hi, Jean.
I'm wondering about the business lending cap. Is there any scenario where you see that cap gets increased? Yeah.
So, one of the things that is something that we have been suggesting as part of the COVID relief, do a 1 year or 18-month elimination of the cap. One of the things that we hesitated on that originally because there have been two changes in policy over the last 4 or 5 years that we think really render the cap, really ineffective. The first was allowing for participations not to count against the cap, and the second was exempting 1 to 4 family non-owner occupieds from the cap. Now, that's only the case if there's a market for their participations, right? Mm-hmm. So, and if that's not the case, then the cap is a problem. It's not in the conversation for this round. But I think if there is a Biden administration and the Democrats take Congress, we know we've got good support for it. Maxine Waters and the folks and the Democrats on the Financial Services Committee are supportive. We get a Democratic majority in the Senate. I think that the dynamics change a little bit on it as well. But we kind of looked at it, again, absent the pandemic and absent an economic crisis and a functioning market, we kind of looked at the change in the participation and the exemption of the exclusion of 1 to 4 as another way of fixing the cap. So if that's not the case, if the market's not doing what we hoped it would do, then we'll have to look at it again.
Do I recall some portion of the banking lobby claiming that credit unions were being opportunistic on the pandemic and everything, and any mention of trying to raise a cap and all that business?
Well, listen, I think that anytime you're a couple things. One, we weren't being opportunistic. What we were doing is we were trying to help. Right. And one way to do that is to make it easier. So we don't have to have the hoops of participating out the loans to free up more cap space. The second thing was that our proposal was going to be temporary in nature. So we had a plan for it to allow for the cap relief for 18 months, but any loan that was made during that time would never count against the cap. So it had a good sort of a ramp down provision, if you will. But you know, they said that, but you know, that's clearly not our intention. Our intention was, we've got capital, and let's use it.
Yeah, no, of course not the intention. I was just wondering if, you know, it got that kind of argument, pushback would have gotten any traction with, well, probably with some legislators, but.
You know, one of the things, Joe, is that we're in an environment right now where it is so toxic that any small excuse not to move forward with something is enough not to do it. And, you know, I was on a call, we were talking about the TDR provision and the CLF provision with the Financial Services Committee on Friday. And they were saying, well, these provisions are problematic because they're regulatory relief. Okay, well, what's wrong with regulatory relief in the first place? In the second place, these aren't regulatory relief. The TDR provision isn't regulatory relief, it's borrower relief. Because if you don't have the accommodations in the statute to do the TDRs and you've got to record that, well, you're going to do less of it because your examiners are going to come down on you, right? So we need the cover. So, Congressman, if you want the policy outcome where we're working with borrowers, you got to give us the leeway to do it.
Thank you.
I'm not sure I helped, but I appreciate it.
Hey, we've talked a lot in league circles about, in some of the meetings that you've participated in, about the whole, or ramping up, or at least being on alert for state level tax threats.
Uh-huh.
And I'm just wondering, in the bigger scheme of things, of all the issues that you've outlined for us today, you know, how much that really is of concern to you as a red alert sort of going forward?
Here's my concern. My concern is that this threat ends up being like, what is it? A frog in a unboiled pot.
Pan of water.
Yeah.
Right.
Where it's going to get real bad, and there may not be anything we can do about it, and we may not even realize it. I don't see. I mean, short of the government deciding it's going to take 75 to 80 years to pay for this crisis, I just don't see how they how they get past this without looking at really hard at some form of tax reform. Yeah, and I think that the state governments are going to be in a much tougher shape. Illinois is going to be in a really tough shape. California, New York, probably too. And I just, you know, and for some states, you know, some states don't have a state income tax. So for some state, it's going to be imposing that, or you know, taking a look at things that they haven't done historically. I think there's going to be an incredible amount of change.
Ryan, this is Rob Miller from VSECU. Follow-up question on that. Do you have more or less concern for state chartered versus federally chartered credit unions in that regard?
Well, yeah, I mean, federals are in a little bit of a better position, all things being equal, because they're only eligible to be taxed at the federal level right now, right? A state credit union, in theory, if there was taxation, could be subject to state taxation and federal taxation if it exists. Whether if the federal government were going to go down this road, they would expose federal credit unions to state taxation. I don't know, but right now, no. But as a sort of a academic exercise, that's how I would look at it.
So my concern, even in our Vermont legislature, is, how I feel that we're in, really good stead when it comes to taxation with regard to our 180 legislators, and the majority of them or whatnot. But, they're in times of need, they're all influenced by what their counterparts in other states are doing. And in my mind, it's only going to take one state, and it may be one with very few state charter credit unions. That doesn't matter.
Right.
One that changes their laws such that it kind of opens the door a little bit, and everybody starts pointing to it, much like they all point to the Bank of North Dakota, as a revenue source and all that kind of stuff.
Joe, the first state that taxes its charities is going to be the one that brings the whole thing down for everybody.
Right, for sure. Hey, one last thing I want to bring everybody back around to, and if nobody has any input on it, so be it, but I don't want to lose track of the original question that Ryan had about the whole, is there any credit union concern about mail delivery and the postal system and whatnot? Have any of you experienced slowdowns or hearing or seeing what you do in the headlines? Does it concern you looking forward at all?
This is Rob. I've not heard of them yet. But I'll inquire because maybe I'm just not hearing about them. I don't know if others have a different experience, but I've not heard of them yet.
Yeah, same for me. This is John. I haven't heard it either, but I can check.
Yeah, and I told my team this morning, I don't want us to get drawn into this. This is a political pressure cooker issue, but I could see that this would have an impact if it became real. Again, this could be the type of thing where it's being blown out of proportion in the media. Maybe, I don't know. But if the mail slows down, or if folks stop getting regular service in a widespread manner, I could see how that would affect you guys.
Sure.
Absolutely.
So Ryan, what if I could just shift to one more thing related to credit unions and members. When you think about some of the things that just weren't renewed at the end of July, the foreclosure moratorium is an example. Are you expecting that those types of legislated required actions on financial institutions will continue? I think you could see that going forward in that same-ish context.
So I think this is one of and it all plays together, and it goes back to my comment about, you can't have regulatory relief without consumer protection. One of the frustrating things that took place as the main leaders were negotiating and have been negotiating this bill was we kept waiting for Mike Crapo to put out an amendment to the HEALS Act, and is there going to be a banking title? And he finally put something out there, but one of the arguments against putting banking provisions in this legislation is, well, if you extend the CARES Act provisions, then you have to also extend these other consumer protection provisions and everything. So my guess is that just the way that the dynamics are working right now, it's probably more likely than not that you're going to see some extension of that, in an upcoming bill. Having said that, we haven't seen that on paper in this round of negotiations. But I'm assuming that if the Democrats, particularly the financial services Democrats, get to the negotiating table with the banking committee on a banking title, that it's going to be part of their demands.
Thanks.
I'm sorry.
Hey, we're coming up on the 5 o'clock hour, but I don't want to shut anybody off. Any other comments or questions or observations from anybody? Awesome.
Well, thanks for having me, guys. I know that it's not everything that I had to say was probably what you wanted to hear, but it's what's going on. We're in a challenging time, but I'll tell you that we're in a good position to get through it. You know, as we go forward, the feedback we get from you, the input that we have is critical. I know, John, you've served on a number of our committees, and Joe, you're always involved. So, but others, please don't hesitate to reach out to me and to let us know what's going on.
In these days, Ryan, if you always make sure that you are speaking as a follow-up to a Mike Schenk futurist presentation, it'll make you look really good, really positive sounding.
True.
Thank you. Thank you so much, Ryan, for joining us this afternoon. We really appreciate it. And thank you to all of you for spending time with us on the line this afternoon to have this exchange with Ryan. It's been a good discussion. And again, thank you to everyone. Hope you have a good evening and a good week.
All righty.